the worst impact to the consumer is actually going to be in spring of 2026 and all the way. It's going to hang with us until the rest of the back to school of 2026.
Hi, everyone. I'm Gunjan Banerji.
And I'm Miriam Gottfried.
And this is WSJ's Take on the Week. And today we have a really big conversation on retail. Before that, Miriam, though, it sounds like this week has been all about the AI trade and where we're kind of headed.
Yeah, I think people are feeling maybe not quite as bullish about that as they were last week.
It feels like investors are pausing a little bit and thinking, hey, is everything I was betting on in terms of the upside, right, to companies, to the economy, to people, and in terms of AI, has that run up too far? Are these corners of the market a little overvalued?
And I think this is something that happens with any big trend, right? Like you had warehouses for e-commerce. People were really interested in investing in those. You had, like solar or wind, renewables. That was a big trend for investing. And then people will bid them up. They'll bid up the best assets, and then they'll realize, oh, maybe it's gotten a little overheated. Maybe we've gone too far. Like these are big trends, but how big are they? And it's really hard to quantify.
And what's striking to me, though, is like how quickly it felt like we went from, hey, Meta, these tech companies are paying hundreds of millions of dollars, even billion-dollar pay packages for AI researchers, AI talent. And then recently the Journal reported that Meta is freezing its hiring in terms of AI. And it just feels like we went from 100 miles per hour.
In a couple weeks. Yeah.
Right.
Yeah.
It was just so abrupt.
Yeah, it's strange. And it's kind of hard to know what to read into that as an investor. Does that mean, okay, we're good to go? Like we're ready for this AI boom? Does it mean we've gotten a little bit out over our skis? It's hard to know. But we do have Nvidia earnings coming up, right?
Yeah. And I mean, in recent quarters, that has just been like the financial markets Super Bowl. And I think that's going to be a key indicator for where this trade really goes next. I do want to point out, though, that even though we have had a little bit more volatility recently, like the S&P 500 is still not too far from its record, right? Like this really hasn't been a big drop. We were just in such an extended period of calm in the market, and AI has just led the market higher for so many months that this even pullback in that sector seems significant right now.
But there are other parts of the market that are charging forward while AI is pulling back. Talk a little bit more about that, because I know you've been following it.
Yeah, it's interesting because we've seen, the moves on the surface in terms of the market haven't been too big. But under the surface, we have seen a little bit more of a rotation, right? Where tech has been taking a backseat. You're seeing other corners of the market, like the blue chip Dow has been outperforming the NASDAQ, the S&P 500, which hasn't happened a lot this year. You're seeing stocks like Caterpillar and those industrials companies kind of lead the way a little bit, which has been interesting to see.
Yeah, I mean, these are sort of like the solid backbone of the economy, but people have kind of left them on the wayside as they've really charged forward with the big seven, the Magnificent Seven.
Exactly. It's like everyone's been transfixed with tech, with AI, and now all of a sudden, like these unloved corners of the market have gotten a little bit more love the past few days.
It'll be interesting to see how long that lasts and whether Nvidia's earnings reverses that yet again.
I feel like every time this happens the past few years, people are like, oh, this is the start of a big rotation. And then tech ends up leading the way once again. So we'll see this time.
I mean, it is a big source of growth, so it's hard to overlook. But, people do get nervous about overdoing it, I think.
On this show, we've been talking a lot to investors Sebastian Page, Imran Khan of Pro-Am Asset Management about are we in a bubble? Has the speculation gone too far? And even when people are saying, hey, there's reasons to be cautious, it's just so tough to time the end of the bubble. Like it's basically impossible to do, right? So I think even people who are cautious are finding it tough to bet against the AI trade.
Totally. I mean, if you're cautious, you're leaving a lot of money on the table over the last few months. Well, one area of the market where there's still a lot of uncertainty about valuations is retail. And that's what we're talking about in today's interview. Tariffs have had a huge impact on retailers, and a lot of that has yet to show up. At Target, we saw that company name a lifelong employee to the role of CEO. The company also reported its second quarter earnings, which were really somewhat disappointing. Shares skidded. And their same-store sales, or comps, also known as comparable sales, which measure sales at locations and digital channels that are open at least a year, actually fell for the 11th straight quarter.
11th straight quarter?
Well, 11th straight quarter of flat or falling comps.
Okay.
So that was not a good sign. Target's one of those ones that isn't it's not just tariffs, but it's a lot of things that are kind of like contributing to their malaise. On the other hand, we saw Walmart, which is taking share. Its comps rose 4.6%. So it's doing better. And it's already, pushed through some price increases related to tariffs. It did say that more price increases are to come, but I think what the company's been doing is passing along some portion of the price increases and absorbing the rest of them, hoping that it can make it up in higher sales. And like its pricing hasn't risen as fast as others. And so that's sort of been Walmart's strategy, which seems to be working.
You are the private equity expert, but I also think of you as like our retail expert because you used to cover retail.
I used to cover
right?
retail for the Wall Street Journal's Heard on the Street column. Yeah.
Yeah. So I'm curious, like, what is your take on how healthy the U.S. consumer is in light of some of the retail earnings that you've seen so far and the conversation that you had on retail recently? Like, I think that's the big question for the economy right now, right?
I think it is. But, I always go back to, the mall being such a ruthless place for companies. Like, it's just hard to survive as a mall retailer,
Yeah.
We've seen so many of them like go out of business.
Yeah.
And they've had to close a lot of stores. So the question is, like, which ones are actually primed to do well in this environment? And it's really hard to know ahead of time. And so I think investors are going to be watching these earnings really closely to see, like, who is hitting it right, who's getting the fashion right, the inventory management right, and the pricing right.
And you touched on that a little bit in your conversation with our guest this week, right?
That's right. I spoke with Adrienne Yih, Senior Retail Analyst at Barclays. And just a heads up before we get to that, Barclays has a financial relationship with a lot of the companies that come up in the interview. Those include Lululemon Athletica, The Gap, On Holding, TJ Maxx, Burlington, and Urban Outfitters. It has a short position on American Eagle Outfitters and a long position on Abercrombie & Fitch.
And that's coming after the break.
We're back with Adrienne Yih, Senior Retail Analyst at Barclays. Thanks for joining us, Adrienne.
Thank you very much for having me.
So I'm going to dive right into the big topic. Retailers, particularly apparel retailers, are some of the most affected by tariffs because of the amount of their products that comes from overseas. How much has that shown up in their pricing so far and then, conversely in their stock?
So the interesting thing, we keep talking about this year as the year of two halves. The first half, we've seen no tariff impact. We've seen a lot of tariff discussion, but effectively no impact on the health of the consumer, on the prices in the landscape, and they've put up great numbers. So if you were to look at the first half of this year, the U.S. consumer is, by and large, extraordinarily healthy. And so as we go into the kind of the bulk of the earnings that are about to come, you're going to see that most of them are beating the second quarter. To your question about when these prices went through, they just started. They literally just started coming through. The prices started going up on 7/1, so July 1st, and they are largely in there sort of as we go into the August timeframe. But not everybody has taken them. They're trying to do the initial phase of the April 2nd tariffs. They're trying to do them in all manner except to raise prices. So you're going to start to see people on the second wave of them really need to raise those prices, but the consumer is just starting to see that price increase, probably like low single digit, but they're going to start to see it as they go shopping for back to school. And that's going to be the first time where they have that like shock, right, when they go to check out.
And when you say in all manner besides raising prices, what are other things that they're doing?
So the first and easiest one, right, would be just, pass it on to the consumer. But that's the one that no retailer really loves to go after, right, because there's an elasticity issue there. And so the first thing they do is they go back to their vendors, the contract manufacturers, and everybody at every point in the supply chain, and they ask for, can you give me a little here? Can you give me a little there? That's the smallest part of the entire kind of retail price. So they're not working with a lot of give. The margins are very thin down at that manufacturing side. The second mitigant would be that if you are a multinational, just don't ship it here. If you make it in China, ship it to Europe. So that's a very easy way. So those companies that are 30, 40% non-U.S. can do that. But if you're 100% U.S., you absolutely can't do that.
You don't have that option. Interesting.
Absolutely.
So among the retailers reporting this coming week are American Eagle, The Gap, and Abercrombie & Fitch. How much can we expect them to say on their earnings calls about these planned price increases?
So each one of them had reported their first quarter before we obviously got, well, all of them will have, right?
So
Because
they've said nothing yet about
the second wave. So
Interesting.
about the first wave, they've said, oh, we're using all these different things. Gap in particular said, we, at the first pass of this, don't want to raise prices and we'll do everything we can not to raise those prices. They probably won't be able to do that on the second wave. And so most of these companies are going to have probably, I mean, if you think about it, it was 30% exposure to China, which most of these companies have less than 10% exposure to China, except for American Eagle that has about 20. And the rest of their product was made in global minimum 10% places. Well, the places that they make them are Vietnam, India, Cambodia, right? Those are all now minimum 20%.
Wow.
So this is a doubling of what we had then heard. Again, they will have implemented some of these price increases. And the other thing to think about is as they go to guide, right, for this calendar year, the second wave of these that are not going to impact them because there's a grace period. Anything that arrives here before October 5th is going to be in the first wave of tariffs.
Oh, I didn't realize that. Wow. So when will we see the price increases?
Spring of next year. And this is the gift that keeps on giving. So it's really
We're not out of the woods for a
not at
while
all.
on this. Yeah.
I think that the worst impact to the consumer is actually going to be in spring of 2026 and all the way it's going to hang with us until the rest of the back to school of 2026.
And we won't really see this priced into the stocks then until we see how well they do on taking those price increases. Or how does it work?
So the stock market is very savvy, right? The stock market is a forward prognosticator of what they think will happen in 6 to 9 months. So I think you are going to see from a stock perspective, for those of you who are investing in this space, I think you're going to see the worst of the stock reactions as we come off of this current quarter and then into the November quarter. Right. But I would definitely keep my powder dry if I'm an investor, because at the end of the day, what we also know is that calendar 26, those numbers need to come down as well. By the time you get to a calendar 26 full year guidance, I think you're in the clear. Absolutely in the clear from an investing standpoint.
So, one thing we hear about in other industries is companies like stockpiling goods at the previous price. Can inventory management be a lever that, these retailers use to mitigate tariffs in the short term, or how does that work?
So in the short term, absolutely. But the key thing here is you have to have evergreen product that you have every faith in the world that the fashion's not going to change. So we've seen the hardline or the furniture companies do this with much more success. They turn their inventory a couple times a year, right? The apparel retailers, we've seen them try to do some of this. It is a very dangerous game. You're
Because of the fashion risk.
Because of the fashion risk.
Yeah.
So if you were trying to bring in inventory, in April or May, you haven't had $1 of what we call fall demand. I mean, you could stockpile denim all you want, but as we know, the denim even shifts, right? The leg opening, the rises, and all those types of things. At the end of the day, a retailer is already guessing 6 to 9 months out. Now you want to guess a year out. And packing away product is never a good idea because the fashions do, even on a guaranteed item like denim, they actually do change a little bit and the taste kind of shift
and
away.
Getting the fashions wrong could hurt you more than the tariffs.
Absolutely.
Yeah.
Right? The worst thing you could do is end up with a bunch of wide leg denim when skinny leg came back.
Oh, man. It's hard to be a fashion retailer. So, speaking of selling, we're in the midst of the all-important back-to-school season right now. How important is that for these retailers, and kind of what can we read into it?
It's extraordinarily important. It's second only to holiday. You have to get these kids in clothes, before they go to school. So there's kind of, we like that kind of deadline because they can't really wait forever for the great price. Although we are seeing it very promotional already. Everybody's trying to kind of get ahead of each other.
Not a great sign, I guess.
Yeah, they want to scoop up the dollars.
Okay.
And we saw that with Amazon Prime Day going a week earlier. They want to, when you think the consumer is somewhat tenuous on the horizon, you want to get to their dollar spend before somebody else does. So it's not even competing, tete-a-tete to get apparel to apparel. It's just for the dollar spend. So, it's extraordinarily important. And I would say there's a high correlation between how you perform in back to school and how you perform in holiday. So if you're investing in this space, what I would say is look to those retailers who are going to tell you and Urban Outfitters, right? The Hollister component of Abercrombie that are Tapestry, Coach just reported a great quarter. Those are the companies on running that are telling you the consumer wants my product and they're willing to pay full price for it. And then what happens is the kids ask for gift cards from those hot brands. And then they end up getting a good holiday.
And that drives the holiday
Yeah,
sales.
so it's very virtuous.
Yeah. Interesting. So we can kind of see who's gotten the fashion right at this moment. So that's something to look out for in these earnings, it sounds like. Yeah.
We always say from an investing standpoint or watching these companies is play the momentum from back to school to holiday. The stocks will get more expensive. Those who have it, have it. So don't try to kind of break with that momentum and then try to buy the cheap one that looks like it's down and out.
It's cheap for a reason.
Correct. That's absolutely correct.
So interesting. Are there any retailers that could benefit during a time of rising prices? Like, what about the discounters?
So there are two reasons why a consumer will spend money while under seemingly duress, inflation being the stress point. Number one, they really want it. The brand's so, like, on running, right? They're running a marathon. It's $170. It was $160. You will buy that shoe, right? Because you need it. The other reason that consumers, when they feel like they have less spending power, they want value. So the off-pricers are uniquely positioned from two fronts. Number one, they're creating value. And I don't mean cheap. Value is very different than cheap. Value is price paid for quality received. $10 when you're paying that for something you think is worth $20 is different than paying $10 for something you think is worth $5, right? And so TJX, Burlington, Ross are uniquely positioned to create this value. On the other side, they're also uniquely positioned from all this dislocation in the inventory. It arrives at the wrong time. You've front-loaded the wrong stuff. You're competing really hard, and you can't sell all the stuff because somebody undercut you on pricing. They're uniquely positioned as the cleanup crew on the back end of this.
So they're getting whatever merchandise kind of falls through the cracks and doesn't sell or was too expensive to begin with.
Exactly.
Yeah. So these tariffs are somewhat unprecedented in history, but is there any other comparable period of time that investors should look to for a sense of like what we're heading into here?
So the like period that I want people to go and analyze is actually the cotton inflation bubble of 2011. And it was the back end of 2010. So within 6 months from like August in the back of 2010 to March, the peak, spot cotton went up 300%. And in March, the companies were forced to lock it in because they had to manufacture their product for the fall season. So they all locked in this price point, particularly the denim retailers, an Eagle, an Abercrombie, and Urban Outfitters, a Gap, right? They were forced to actually raise their prices on these goods by about 10%. The cost of the inventory went up by 15%. We're getting to those numbers. We just published, a note that said at these new levels, the cost of inventory is going up between 10 and 15%. And the pass-through that would offset that fully is 8 to 10%.
Wow.
So we're getting very close to those numbers that I said would probably pop up more so like in the spring time period. The irony of it is you generate sales. You actually these companies generate positive comp sales. And so if they needed 10%, and they generate a 5% comp, we're taught in retail to be very happy that we're generating sales.
Right.
So it's kind of like a false positive.
Right.
But the difference between needing to pass through 10% and only getting 5% will show up on their margins, on their earnings
And that's
print.
a lot. Yeah.
That's a lot.
Yeah. So as an investor, you kind of have to be wary of that.
Correct.
Yeah. I mean, yeah. Positive comp seems great for a retailer because it's not always a given.
That's like the lesson number one is if they're positive comping, you want to own them. Right. Except in this case.
Except right now.
Yeah.
They have to be doubly positive comping or something
Exactly.
like that. Yeah. So in the years leading up to the COVID-19 pandemic, there was kind of like a steady increase in the percent of shopping that was done online. Where are we now? Because I know that during COVID, obviously nobody was going to the mall, but then right after, everyone went back to the mall. When everyone went back to shops because there was this kind of joy of being back in society. Where are we now in terms of this breakdown between shopping online and shopping in stores, and what does that mean for margins?
In my discretionary apparel footwear space, I would say just split it down the middle, and that's where we're kind of, simmering.
We're moving toward 50-50?
Yeah, we're moving toward 50-50. We've got companies that are, north of 45%. Urban Outfitters, Lululemon, right? There are companies that started as brick and mortar and are really, really close to that 40-50 number. I would say where we are generally is mid-30s, pushing on the, getting to the high 30s. But I would say at this point, it's kind of a steady march of a couple percentage points of penetration every year. And we talk about this as it really is the way we want to shop.
Yeah.
And so it's really the consumers that are driving these companies to give us more in the landscape.
And what about the store footprint? Are they still having to close physical stores, each of these companies, or are they at the right levels now?
A lot more people go to, lifestyle center, street locations and those. But I would say for the most part, we're done with the huge, heavy, single brand store closures. But what we're not done with is concept closures. So concept closures are just like brands that aren't going to work out. Right. So like American,
if there are two brands in a company.
Exactly.
Okay.
Or even just like, companies that are hangers on from, post GFC. What we say about the tariffs is we look at them and our initial reaction is, oh, they're so bad. Every company's like, we don't like tariffs, right? They're so bad. And at the end of the day, they are the universal equalizer of, a healthy landscape. At the end of the day, what will happen is those companies who have 5% margins and have to eat 300 basis points of tariffs aren't going to be around.
Right.
And those who have 15% margins and eat 3% will go to 12. And then in 2 years, they will have a healthier landscape where the bad performers aren't constantly liquidating goods in front of them.
Right. It's such a fascinating industry. We're going to have one more question with Adrienne Yih after the break. We are back with Adrienne Yih, Senior Retail Analyst at Barclays. Adrienne, in 30 seconds or less, which retailer do you think has the most pricing power right now?
Oh, you know what? It's On Running. They are so early stage. So I don't know if everybody's familiar with On Running, but they are a nascent premium running shoe that kind of really came to the forefront sort of during the COVID pandemic when everybody was sort of running or walking. I would say they have so much kind of momentum right now. They only have about 29% aided brand awareness here in the United States. And I think people are still discovering them. And at the end of the day, the use case for them is actually to run a marathon. So people aren't going to skimp on pricing when it comes to kind of their sporting endeavors, typically.
Awesome. Thanks so much.
I mean, you still see Chico's stores around. You
right.
still see Talbot's.
My grandma shopped at Chico's.